Here is our game plan for today. We'll be looking at the global Forex market, why currency values fluctuate, the mechanics of going long versus short, understanding pips, lots, and spreads, and finally, leverage and risk management.
Section 1. The Global Forex Market. Let's get into the basics. To really wrap your head around Forex, which, by the way, just stands for foreign exchange, think about converting your home currency into foreign cash for a vacation. You hand over one currency, and based on the current exchange rate, you get another one back. That incredibly simple transaction is the absolute foundation of this market. But take that and scale it up globally, and it becomes an absolute behemoth. We're talking an estimated $5 trillion traded every single day. Just to put that into perspective, that completely dwarfs the world's stock markets. Now sure, some of this is for international trade and regular travel, but the vast majority, it's traded by speculators, hedge funds, massive financial institutions, and retail traders who are just looking to profit from minute, everyday price fluctuations.
Now, unlike the stock market, which operates out of physical, centralized locations like Wall Street, Forex is what we call an over-the-counter or OTC market. Basically, this means it's totally decentralized. It operates continuously from Sunday evening at 2200 GMT straight through to Friday evening at 2200 GMT without any central physical exchange. It relies entirely on a global network of computers connecting banks and individuals worldwide. When Tokyo goes to sleep, London is waking up, and then New York takes the baton. It's a market that truly never sleeps.
To figure out how we actually measure value here, you need to know that currencies are always traded in pairs. Think of the euro and the US dollar, the EUR/USD. The price you see simply tells you how much of the second currency, which we call the quote currency, is needed to buy exactly one unit of the first currency, the base currency. So if the EUR/USD is trading at 1.0500, it simply means it takes exactly 1.05 US dollars to buy a single euro. Pretty straightforward, right? Section 2. Why currency values fluctuate. What's actually moving these numbers? So the market is constantly moving, and it's driven by a really diverse web of influencers that shift supply and demand on a daily basis. At its core, it's just basic economics. When demand for a currency rises, its value goes up. When supply is excessive, it falls. Traders are constantly making bets on what they expect the future to hold, obsessively watching economic calendars for data on things like employment rates, GDP growth, and consumer sentiment. All of these act as vital signs for the overall health of an economy. Let's look a bit closer at the heavy hitters shaping supply and demand. Number 1, central banks and interest rates. When a central bank, like the Fed, raises interest rates, foreign investors tend to flock in because they want those better returns. That extra demand strengthens the currency. This dynamic also drives something called the carry trade. That's where traders literally earn interest simply by buying a currency with a high interest rate while selling one with a low interest rate, pocketing the difference. We also have to look at the balance of trade. If a country exports more than it imports, a surplus, demand for its currency rises because people need it to buy those goods. On the flip side, high inflation eats away at purchasing power, which weakens a currency. And of course, geopolitical stability is huge. Money craves safety. If there's political upheaval or conflict, investors pull their capital out fast, which can cause a currency's value to absolutely crash. Section 3. Going long versus short. How do traders actually capture profits? In trading terminology, market sentiment is divided into two very distinct camps. You're considered bullish if you expect a currency's value to rise, which is represented by a charging bull. On the flip side, you're bearish if you expect the value to fall, represented by a bear swiping its claws downward. Now, because currencies are traded in pairs, here is the really cool part. You can profit regardless of whether the market is going up or down. You go long and buy if you think the base currency will rise in value against the quote currency. Or you go short and sell if you predict the base currency will weaken. It's all about forecasting the relationship between those two specific currencies. Section 4. Pips, lots, and spreads. Let's dig into the actual mechanics. The core unit of measurement in Forex is the pip, which stands for percentage in point. A pip is the basic unit of measurement for your profit and loss. For example, if the Euro USD moves from 1.1050 to 1.1051, that tiny fraction of a fraction at the end, that is exactly 1 pip. As a quick side note, for Japanese yen pairs, the pip is usually located at the second decimal place, but the underlying concept is exactly the same. So what is 1 pip actually worth in real hard cash? Well, the monetary value of that single pip depends entirely on your lot size. This is just the volume of your trade. It scales all the way from a tiny now lot up to a standard lot of 100,000 units. For instance, if you're trading a standard lot on a major pair, a single pip movement is worth about $10. But if you're just starting out and trading a micro lot, that exact same pip movement is only worth 10 cents. Let's trace the math on a successful trade so you can really see this in action. Say you buy one standard lot, and the market moves 50 pips in your favor. You just multiply those 50 pips by the $10 pip value, and boom, you walk away with a $500 profit. It perfectly illustrates how even the tiniest decimal movements can translate into significant capital, all depending on your volume. But hey, trading isn't entirely free, right? Before you realize any profit at all, you have to overcome something called the spread. The spread is the small gap between the buy or ask price and the sell or bid price. Basically, this is your broker's fee for executing the trade. Because of this built-in fee, the very second you open a trade, you are technically starting slightly in the red. The market has to move in your favor enough to cover that spread before you see true, realizable profit.
Section 5. Leverage and risk management. This is the big one.
Looking at those massive lot sizes, like 100,000 units, you might be wondering how average retail investors can possibly afford them. The secret sauce here is leverage. Leverage allows you to command a massive position in the market with just a fraction of the actual money. Think of it as a margin loan from your broker. For example, a 30-to-1 leverage ratio means a trader with just $5,000 in their account can command a $150,000 position in the market. It's the mechanism that allows everyday traders to participate in a market originally built exclusively for global megabanks.
However, we absolutely must stress this. Leverage is the ultimate double-edged sword. Yes, it brilliantly amplifies your potential gains, letting you reap the rewards of a $150,000 trade, but it equally magnifies your potential losses. A tiny adverse price movement on a highly leveraged position can wipe out your initial account balance incredibly fast. This makes strict position sizing not just a good idea, but a matter of sheer survival in this game.
So, now that you understand the raw mechanics, the pips, the lots, the spreads, and the immense power of leverage, the ultimate question is this: how are you going to apply disciplined risk management before you ever click buy or sell? The Forex market offers unbelievable opportunities, but it demands serious respect and careful calculation. How will you protect your capital while navigating the wild currents of global currency? Let that sink in. It's a lot to process, but we'll be exploring even deeper strategies to tackle exactly that in our next explainer. Keep studying, and I'll catch you then.